My name is Susie Jose. I am the owner of Carefree Bookkeeping in Minnetonka, Minnesota. We provide your bookkeeping service and additional accounting services. We customize everything for what you need because I know the struggles of a small business owner. If you guys went into business to do bookkeeping and accounting, you guys would all be accountants. So, and that's just not how the people are made. We can't all do the same thing. We need each other. So, we will go ahead and get started here. Again, questions, just pop those in the chat. And I have everybody muted so we don't have that background noise. And so then just raise your hand. I don't know if I can see everybody, but yeah, just put it in the chat and we'll do the best we can. Okay, here we go. The first thing we need to have to do any planning or know what's going on is your books need to be clean. They need to be updated. And so we have real live numbers to look at. Just remember, bookkeeping is a historical view of what happened, and we don't know where we're going unless we know where we are. And that's why we do this. And I'm not a judgmental person. It is, you do what you can do. And we get it to where there is. I have another class, I believe it's on my YouTube channel, about the cash flow and reading reports. So you guys might want to jump and do that. But for this class, we need to, especially S Corps, but my company, we do it. If you're an LLC or an S Corp, we run the books the same exact way. Because then we know that they're audit proof. If you get that phone call, or there won't be a phone call, but if you get that lovely letter, the first thing they ask is, are you tying out your bank accounts to your books? So that is why we reconcile. It's not just entering everything into your bank feed and going, yep, it matches. No, there is another button for bank reconciliation that needs to be done. And we also do that with all the credit card statements, any loans, any of those kind of things that would have that third party statement, monthly statement. If you run an AR, which is accounts receivable, billing your customer, or an AP report, which is accounts payable, paying your vendors, we need to review those, make sure those are clean up. If there's some old invoices on there that you're never going to get paid on, then let's get those cleaned up and out of there. So we always want to review those. And then when you review your reconciliation reports, are there any old transactions that are sitting out there that are not being marked in the books as being cleared? That would be somebody lost a check and never deposited it. So we need to contact them going, do we need to reissue this, or do we just void it and clear it out? Is that invoice or payment double entered? So we need to do a little research and clean that up. So those are all real important, because if you have two payments for $5,000 come in into your books, but it only was paid once, we want to make sure we get that extra $5,000 out of your sales, because that's where you're going to be paying your taxes on. Okay, so when we look to see what needs to be balanced, what needs to be looked at, I do that from the balance sheet. It's the checking, the savings. We're going to review the accounts receivable, the undeposited. Why is there an amount there? Is that the amount that's still in your hand on its way to the bank? So if anything gets held up in there, that might be also a double entered. So it needs to be only the transactions that happened within the last couple days. Or if you're intentionally have a check in the drawer type thing. AP, make sure that's done. Your credit card, here's your loan payment, any tax or sales tax, payroll tax that should only have in there what's due in January or what that payment. So it accrues through the month of December, and that's the payment you're going to be sending out in January. Notes payable. All of these accounts should be reviewed and balanced as best as you can or adjusted. By doing that, you're proving that your P&L statement, your profit and loss income statement, it has 5 words to it, is correct. It all ties out. It's going to match up to something on the balance sheet. So then you can prove, nope, my P&L statement is correct. That is why I do it for both the LLC and the S Corp the same exact way, because I want to make sure nothing is double entered on the P&L side. So when I talk about LLCs, S Corps, which are the 2 most popular structures, entities for your business, the LLC is technically not labeled as a taxable entity according to the IRS. That's why you get the letters sometimes after you send your 1099s out that say, well, you can't match up this person. It's because they're using their federal ID number and the IRS doesn't recognize it, or they didn't tie that back to the social security number, that kind of thing. So they don't determine this a real entity. Most everybody uses the S Corp if they're not LLC. The corporation, that's an older term that was back before S Corps became available. And this, some people still use this. The corporation pays for the taxes. The S Corp and the LLCs are pass-throughs. Well, the LLC is on your personal tax return, but the S Corp is a pass-through to your personal return. And then partnerships aren't used very often because you can have partnerships inside the S Corp and the LLC. And it's just, those are taxed differently and looked at differently. Your corporations, one reason for, and I think there's a slide for it later on, is if you ever get the love letters from the IRS saying, hey, we've selected you for audit or we have questions, if you are an S, a corporation or partnership, you will get one auditor in one state. And for your personal side, you will get a different auditor in a different state. And they really don't talk to each other. So that's one of the benefits of having these kind of corporations is that. But these are all the different type of corporations you can have. Now, you could also have different structures. So some people have a handful of companies that are LLCs doing different things, or more like real estate people will have all of their rental properties as an LLC, then have it into a holding company, or lots of different businesses under a holding company. So there's lots of different options and choices for tax strategy for those kind of things also. And the fun thing about the S Corp or the C Corp company, you don't have to go on the calendar year. You could do, let's say, a March 31st calendar ending period. Now, your taxes are due at a different time. You could see how that year turned out and have more room to make changes or different tax strategies for that. So these are things you want to consult with your CPA on that, and not just a lawyer, because the lawyers don't understand the tax strategy on all of that kind of things. Okay. So when you're filing as an LLC, you are filing on a Schedule C or Schedule C filing. And it looks like this. It says Schedule C. It's on your 1040. It says profit and loss. Puts your social security number. You would put your federal ID number that you're assigned. If you have one, you put your gross income here, and then down here you list all of your expenses. Okay, and then you have this dollar amount of this is what the business earned. All of that is taxable for the FICA tax, which is your Social Security and Medicare. That is at 15.3%. So that's not your withholding for state or federal. That's what you're responsible for. There's another little form that says SE, and that comes over onto your tax, your regular tax income statement. So when you do that Schedule C form, that line, I believe it's 31, it got cut off on that slideshow, but your qualified business income comes over, and for this example, it was $13,395. Now, that amount is taxed at that 15.3%. So if you're an LLC, you look at, here's my net income. So we'll do it right here. This is an LLC. It comes down. Net income, 115,000. They're paying 15.3%. Whoops. On that to start with. And then it's whatever tax bracket they fall in. Then we put those in if it's 24% for federal and say 6% for the state of Minnesota. Those are on top of those taxes. And then you have your personal deductions, all of that kind of things. So that's when we start coming at this 100,000 as the operating net income, meaning your sales minus your gross profit. And if everybody had this kind of gross profit margin, I'd be super excited. Minus all your operating expenses and come down to this number. That's when we want to start talking. Do we change from an LLC to an S Corp? So those are things you want to peek at your books right now and see, because we can back end it yet. Through January, depending on when you are sending out your W-2s. Sometimes we can get that back ended and get you as an owner thrown in and get this reduced, because when we do that, here we have the same for gross sales and the same for all of the expenses, but I added in the expenses that an S Corp gets to do versus the LLC. So this company filed as an LLC in 22, but because they had 124, we're like, hey, let's make you an S Corp for 23. Now they get to add in all of these other additional expenses. And this retirement can be 25% of whatever the wages are. That depends on what vehicle you use for your retirement. And I use the word vehicle because you think cars and how many different kinds of cars there are out there. That's how many different kinds of retirement programs there are out there. So in 22, they had $124,000 as their net income. And as an S Corp, they now have $67,000 as their net income. So that is a $57,000 difference on the top. Now they don't have to pay the 15.3 FICA tax on this 67,000. So that's another 19,000 of savings. So that's a tax difference of what is taxable, not the actual tax they paid, but the number we're using to figure up the taxes of $76,000. And my favorite thing, so if this person here still had $67,000 as a taxable income, I would be encouraging them to get as much cash as they can into their retirement to lower this taxable amount. Because my favorite thing is paying your future self first to reduce taxes, because that money is still your money then. You're not wasting it out there on something you don't need, and you're not paying the government on that. So if this was 20,000, and even at 20%, that would be a $4,000 tax savings right there. So, and it's still your money, and it's there for when you retire. And there's some other fun additional, if this rolled into a holding company, then you could charge the holding company money. Other fun things you can do that as you get so expansive that we need to do more advanced tax saving plan. So when you are an S Corp or a C Corp, you are only paying the FICA, the Social Security and Medicare, on your W-2 amount. So when we're looking at this person, the owner wages were $46,000. That's all we're paying for that FICA, where the prior year they paid it on that $124,000. So that makes a big, big, big difference. Also, as an S Corp, you can take distributions and you don't pay any FICA on that. Now, you do end up paying withholding on that. So everybody will say it's tax-free. Well, it's not tax-free. It's FICA tax-free. So there's still going to be withholding that you're paying on that. And then this is something you also want to talk with your CPA, because on how they set it up, this does reduce your capital in the business via how much you're pulling it out. So let's say you're trying to sell your business in the next 3 to 5 years. Then we want to reduce the distributions to leave capital in there so your books look better. And then we might just want to raise your wages by that amount. So, and that's where you want to talk to a broker too, and you want to plan that stuff out, going, hey, I want to just set up an exit strategy on this. So, and then what happens, and you could put, health insurance in here too for the owner. All of this flows onto that K1, and you get a K1 then that attaches to your personal return. So the one added expense by having the S Corp is there's an additional tax return that needs to be filed. So then your CPA will be charging you for that additional tax return. And that could range $1,500, $3,000 range, depending on your CPA. Does that added expense, is that lower than what we're saving on taxes? Yeah. So I'm okay adding additional service for that, just so people are aware of that. And your S Corps are due on March 15th. Same with the partnership. People are always think April 15th. No, your business returns are due on March 15th. And if for some reason you're like, I don't have the cash flow to maximize this retirement that we want to do to lower this income, well, then we know we make our estimated payment to get what we figure. Let's say we're going to pay that at 12,000 instead of 1,200. The CPA figures up what your taxes are going to be due. Those taxes are still due on April 15th. However, the retirement is not due yet, and it's not due until you file your returns. So if you're seasonal and you have a lot of your income comes in the summer, cool. Let's file an extension, pay the taxes based on what we're going to be paying for the retirement account. When that gets paid in on July 1st, then let's file your taxes in July, and then you're done for the year. You don't have to worry about it. You don't have to stress that, did my CPA file or not by the extension date, all of that kind of stuff. So that's what I encourage, is as soon as we have that money and we get it paid, go ahead and tell your CPA, hey, that's all paid. Can you please file my taxes? Okay. So some of the things that are also on that K1 form is, did we take any additional bonuses? Did you make so much money that your CPA said, hey, I need you to take a $75,000 bonus? That comes on your K1. Your distributions, your owner draws, lowering your value in your business. So when you sell it, you get less, but you've already pulled that money out. That goes on your K1, and things like health insurance or any other, let's say you pay your HSA from your business account, that goes under owner distributions, your taxes. So I like to pay the owner's taxes out of the business account just because it's easier to track. We have a bookkeeper already tracking all of this stuff for you. And I can run a report quick going, CPA, here's what they paid for estimated tax payments, to enter in on the tax form, because they have to put in every quarter that you've paid that amount you've paid. Easy to track. You're not digging through, what did I do? What did I do? What did I do? And going through 12 months of payments. That also comes under owner distributions as a money out of the business, but it's just easier to track. The business is why you have to pay those taxes, so I just let it come out of the business. Okay, so this is what the S Corp tax return looks like. So this one right here is missing salary and wages. Okay, if you're filing as an S Corp, the owner is required to take draws. That is one of the reasons, or salary. That is one of the reasons why you are filing as an S Corp, because you want those deductions that way for the owner. Some like real estate, it's just them working, but they make enough money where they need to file as an S Corp. We still need to have the payroll going for those people. I just set that up on a monthly payroll, simple. It goes by itself, and we just kind of have to look at it at the end of the year to see if we need to do a bonus or adjust it in any way. If it's cash flow issue, we can go in and lower it and watch that, but it makes the Social Security office and the IRS the happiest when you can just do a monthly payment and they can see each quarter something's getting paid into them for payroll taxes. This is one of the little things that the computers flag going, and banks flag, that the owner is not pulling any salary and paying Social Security on from an S Corp. Social Security office is second to the state of Minnesota in who I absolutely do not want to fight with. Um, I would rather fight with the IRS than the state of Minnesota or the Social Security office. Okay, so anyway, side note. Um, Here you have your gross income, your sales, the rent or any other deductions. There's not very many deductions for this person. They have some on the statement too of other. So if it's not listed here and you're like, no, I call it this, it goes on statement two. The total of deductions. Now here's you have your ordinary income. So this is what would be your withholding taxes calculated on. So then that comes over here onto your personal return at that $85,000. And then your standard deduction comes in, and then most businesses get a qualified business deduction on top of it, which is another attachment that the softwares figure up for you or your CPA figures up for you. So then now they have a taxable income of $58,000. Now, if it was an LLC, this was their income, that would be taxed with the 15% Social Security on top of that. So that's where that comes in. So we always want to make sure we're managing our tax brackets. So here we have that $85,000 from the page before and their taxable income of 53. And then here is the taxes they've paid in. So they paid from a W-2, they paid from estimated tax payments. All of that's totaled up and going, yep, you owe $19,000 in taxes. And if this is a single person here, if they were married, this would be 24 or 25,000 here as a deduction. But we're just using this as a single person. So what you do then when you're looking, say, let's look at last year's return, and you grab these numbers from your last year's tax return. You grab, this is your total taxes, and divide it by your taxable income. And that number comes to 36%. So this person is paying 36% of their income for their tax withholding. For these numbers, I'm like, that's a little high. Can we fix something? Let's get that retirement money going up further. And that's where we balance what can we afford with cash, but the cash is going to go to the government or it's going to go to you, one way or the other. So we look at those kind of things. And can we add in more personal deductions? I don't see any Schedule A in here. So that probably didn't get calculated in this example. That would reduce this also, meaning your mortgage insurance, any donations, those kind of things. Can we do that? So that's what we want to do. So what I did was I grabbed 23 tax brackets. So if your taxable income, so when I'm doing something, I'm like, okay, here's what's on your profit and loss statement, that amount. Now, for sure, I'm going to deduct you. And are you married? I'm going to deduct those two things. And then I'm going to come over here and going, okay, where does that fall in? Because those are the two big deductions. Yes, you will probably have some other little ones in there, but there's enough of a gap in here. We're going to get in the right tax bracket. So are you single? Are you married? Or head of household? So where does your taxable income line up at? Um, that example had it in the 32 to 35 tax bracket. And in there, can we get it lower to here somehow? Those are some of these deductions to get it lowered can only be done before December 31st. Like setting up a simple plan or a SEP. You need that set up and a small deposit put in there in this current year. And we can do an extension and then put more money into this tax year later on. This year, the standard deduction per person. So you each, after your net income on your P&L statement, get to deduct $13,000 for you. And then another 13,800 for your spouse if you're married and filing jointly. So this changes every year and these change every year. These can both be found on Google, easy that way. But if you're at $183,000, guess what? We're going to find a way to spend some money either to yourself or buying a piece of equipment or prepaying rent or utility. Somehow we're going to find a way to lower it to make sure you're under this threshold before you bounce up. So especially when it's this kind of a from 12 to 22, that's kind of a big jump. And that's what hurts most people is this jump right here. So are we close enough to be able to find ways to lower that? And that's where you're on the phone with your CPA, some kind of consultant that could help with this. Some people know more than others. I don't want to go, well, it's this type of person or that type of person. It's always going to be your CPA, and some other consultants would also know exactly how to do this. My favorite, paying your future self first, getting that retirement plan. Also in here, if your health insurance allows you to do an HSA, health savings account, which means you're probably paying more for your premium for that ability to also put money in your pre-taxed savings account. Now, you don't have to use that tax savings account for the year you're at. Save that, let that build, and use that when you're retired to help pay for services you need as you get older, or if you get sick and you're laid up and you have hospital bills, that's when to use it. So if you can get by without using it for your everyday doctor bills, then that will help your future self. Vehicles or equipment. I have a client that they put so many miles on their equipment that they have to replace it. It makes a financially sound decision to replace that every year, or else they drop and lose such value and have so many repair bills because they're hard on their equipment. Them, I'm like, absolutely replace that every single year. Go ahead and do that. Your vehicle, do you really need your vehicle? Is it costing you money? Then yes, we don't want to just update it just because, oh, I have to, instead of paying into retirement, I want to get a new vehicle that replacing the one you got last year. That one I'll probably slap you upside the head on and going, no, protect your future self. And then a lot of businesses do not do their cell phones or their landline phones or their internet, those kind of utilities. They don't pay it through the business. Where are you taking all your business calls? And they'll go, oh, my family's on it. So what? If you for somehow get audited, and this is just between you and me, I'm okay going, hey, so I owe you $100 in taxes. Fine. I will pay it gladly. But just to get the kids out of there or something. Um, don't worry about that kind of stuff. Don't sweat that little stuff. Let's just get the business to pay the whole thing. Let's get that deduction going. The family side of it's not going to make much of a difference. If you really, really want to, yeah, pay the whole thing, and then we'll do a journal entry to offset the family, and we'll put that as a distribution. But let's not miss out on how those small bills can accumulate. You run your office out of your home, you need the internet. Pay the internet from your business account. Okay, so and we're getting wrapped up pretty fast. I don't think I've ever done a slideshow this fast, but I don't see a lot of questions coming in yet. So hopefully all of you are awake. How we can help. We help with bookkeeping and payroll. And then we do fun things like this, going over helping you plan throughout the year, helping you strategize, pulling your CPA in and going, hey, can you help to make sure our estimated payments are on, or do we need to adjust something? Or at this time of the year, it's how are we looking? So President Trump, and I did not put this in the slideshow, President Trump did a new law that we can, if you're an S Corp, pay your Minnesota withholding through your business and use it as a tax deduction on your business, lowering your federal taxable income. So this is huge. So we have some people paying $12,000, $25,000 out to cover their Minnesota withholding on the personal side. Now, Minnesota, we don't have that kind of a tax on the business. So it goes into the state. The state goes, wait a minute, I don't have a tax return with withholding to put this into. Well, they are going to be returning that money. I have somebody that they're supposed to pay $1,500 in to the state of Minnesota for their corporate withholding tax. So, which it's called Minnesota PTE. Don't ask me what the PTE stands for. It's probably personal tax exemption. So that person's going to be paying in that $1,500 to the state of Minnesota. And we do that online. State of Minnesota wants everything done online. And they are going to get credited $2,000. Okay? They'll get that money back. Yes, they'll have to maybe pay in a little bit more on the personal side or something. There's a cross, especially that first year. You might need a little extra cash to do this. And all states can do this because it is a federal law. So with that, whatever state you're in, this is where you need to talk to your CPA going, how do we figure this out? LLC people cannot do this. This is another advantage of being an S Corp. That money is going to come back to you. You're going to save an additional $500 for your federal taxes. So that again might be lowering you from the 32% tax bracket down to the 24% tax bracket. So that's something, and all of that has to be done by December 31st. That payment has to be sent by December 31st. So, and you pay that on your state's Department of Revenue. And there's a certain category on that. So those are things to make sure you jump in with your CPA going, hey, do I qualify for this? Can I do this? Um, so I try to help you with questions to ask your CPA. Or don't be scared to ask them. There's going to be a yes or a no. And if you don't ask, it's going to be a no. And do you want to make a $2,000 extra tax fee for not asking? So always be asking and challenging. Is there anything different? Don't do that during the busy season. And I'm a little late on getting this class up and going. Because, well, and your CPAs are kind of bored in January. Anyways, they're doing a lot of the updating, doing their education on the new tax laws, because the new tax law book is probably a 6 to 8 inch binder book of all the new tax laws coming in for this year. This is why you use a CPA, because you didn't go to school for tax law and tax savings. They use their program. They don't get involved in the bookkeeping side of it a lot. Some do. But they live in their tax software. So it's up to you guys to challenge and ask, hey, is there a different way that you can figure this out? Is there a different tax strategy we should be doing? So those are questions to check in with your CPA, even starting in October, that fourth quarter, kind of predict how is your year going to end, because you'll know as business owners how it's going to end. Sometimes I even do is, okay, they always have the same fourth quarter. So I'll do a report October 1st through September 30th, giving a whole 12-month look to what this year's going to look like. I'll do that sometimes too for people that are in that higher tax bracket and we need to do more planning for. So that's it. This is me again, and watch my Facebook for other classes that pop up. All the recording is on YouTube. I do some classes about how to read financial reports, and that's given under SCORE. So whenever SCORE has their classes, and all of their classes are free. All of their classes are given by people in the industry that they serve. And you can learn a lot from any of the classes at SCORE. And if you don't know, SCORE is a local volunteer business builder in the state of Minnesota. Just look up SCORE and you'll find them easy. If there's no questions, I will let you guys all go early and get back to work. And you guys have a Merry Christmas and a Happy